All right, I think we'll get started. Welcome, everyone. Thank you so much for joining today's webinar. It's wonderful to have you, so many of you join today. My name is Mayada El-Zagbi, and I'm the Managing Director of the Center for Financial Inclusion, which is housed at Acción International. So we're delighted to be hosting today's event. All of us have been seeing the anniversary events. It's now been a year since COVID-19 was declared a global pandemic. I think we've all been in enough discussions to know that to have heard about some of the initial impacts of COVID and how this has affected low-income people and businesses all around the world. So today's discussion, we want to go a little bit deeper in this conversation. We want to start to look at what have policymakers, regulators, and what have they been doing in terms of addressing the pandemic, and what has this caused, what has that reality been for low-income people and micro and small enterprises as a result of these measures. So CFI has been collecting waves of data on micro and small enterprises in several countries around the globe. We're tracking progress every 2 months to see how MSMEs have been coping throughout different phases of the pandemic. We've also been going deeper into understanding some of the policy measures that governments have taken to ease the pressure on the financial system, on businesses, and on the economy at large. So today, what we're hoping to do is bring these two work streams together. While we can't actually discuss specific causal effects of one policy measure and what that has created on individual businesses or individual sectors, we do think it's important to understand what's been happening at the kind of larger policy environment, what's been happening at the market level, and how this trickles down and affects individuals and businesses. And so we know, of course, that the lockdown measures have hit individuals hard, and they've hit micro and small enterprises even harder. And we've seen a lot of different attempts to address, delay some of the effects of this on the economy by using the use of moratoria. And we've also seen other regulatory flexibility measures that have been tried to, open up the liquidity in the banking system. So what has that created? We'll talk more about that today. So we are especially grateful to MasterCard's Center for Inclusive Growth, which has been supporting this work. So this work that we'll be presenting today was completed as part of our partnership with the MasterCard Center for Inclusive Growth and with GIZ. And today we are fortunate to have Payal Dalal, who is the Senior Vice President, Social Impact and International Markets at the Center, to open up the webinar with a few opening remarks. So I'll hand it to you, Payal.
Thank you so much, Mayada, and thank you for giving me the opportunity to speak to you today. And I'd like to thank our hosts, the Center for Financial Inclusion, for convening this really important conversation. I think it's clear that COVID-19 has put a premium on flexibility and innovation in the face of an unprecedented health and economic shock. And so we really admire CFI for rapidly pivoting its research focus and evaluating the policy responses affecting FSPs in such a timely and insightful way. And we're really proud to have supported this work, which so directly advances our own mission of ensuring the digital economy works for everyone, everywhere. It's really no surprise that COVID-19 has most affected those who started with the least. And the pandemic demands that we really redouble our efforts to support micro and small businesses and financial service providers. And while evidence on the impact is only beginning to emerge, I think it's clear that micro and small businesses have really been severely impacted. There's a significant risk of micro and small businesses failing in emerging markets. I think some of the research we've seen is that nearly 42% of micro and small businesses globally are at risk of failure. And it's already begun. Small firms are going bankrupt. And so helping micro and small businesses be more resilient to survive and then hopefully thrive is going to take a multi-pronged and multi-stakeholder effort. And so I just wanted to highlight a few things that we at the Center for Inclusive Growth are doing to ensure that micro and small businesses weather this pandemic. And really just want to touch on 3 things in my introductory remarks. 1, our work on inclusive digitization. 2, some of the research we're doing. And 3, some of our data for good work. In terms of our work on programs, we've really doubled down our inclusive digitization strategy because we recognize that the constraints on face-to-face interaction has really put a premium on the need for micro and small businesses to access capital through digital loans, to grow sales via digital platforms, to receive technical assistance and training through digital channels, and to use social channels like WhatsApp to communicate with their lenders, their suppliers, and their peers. And I would say that our partnership with Accion is really the cornerstone of our programmatic work when it comes to financial service provider digital modernization. And we really view CFI's research as a template for our own work, using data to examine the impact of COVID on both micro and small businesses and individuals. Secondly, we know how important it is to fully grasp the reality for micro and small businesses, which is why original, innovative, and human-centered research is so important. So in partnership with the Gates Foundation, the Argydius Foundation, we're supporting the Financial Access Initiative at NYU to launch small firm financial diaries across 7 countries. That's really going to build on Eric Noggle's work that he's going to be telling us today. These small firm diaries are going to collect high frequency data through interviews, which are going to help us understand more details on revenue, cash flow, and entrepreneurial decision making so that we can not only fill critical gaps that are going to help inform product innovation and hopefully scale the use of digital financial services, but it's also going to highlight the specific needs of women-owned businesses so that we can better create programs and ensure that digital financial solutions are more tailored to their needs. And finally, the third thing I just want to mention is that we believe in the power of data and the power to use data for good. And so we've really tried to leverage our data and our data expertise to glean insights and to create tools to help community leaders. So for example, in the US, we analyzed our own data to understand the impact of COVID-19 on Asian American businesses and individuals in New York City. And we're currently working with Accelerator for America and Drexel University to create a data tool to measure the disparities in the experience of Black and other minority entrepreneurs to help local leaders develop strategies to ensure an inclusive post-COVID recovery. So those are just some of the things that are going on at the center to ensure that the digital economy works for all micro and small businesses. As I mentioned in the beginning, the center is really honored to have partnered with CFI. The work CFI is doing to ensure that prudent policy adjustments keep capital flowing while also preserving the safety and soundness of the financial system is absolutely essential. I think CFI has documented the flexibility and innovation of regulators and has identified what's worked and what still needs to be done. So I'm really looking forward to today's webinar and hearing about the report and their findings. And I just want to thank all of you for everything you're doing to ensure that micro and small businesses can power an inclusive economic recovery. Thank you, Mayada.
Thank you so much, Payal. I really appreciate your taking the time to join us today. So Payal will remain available. So if people have any questions, please feel free to put in your questions using the Q&A function. We will be reserving some time at the very end to get to those questions. But today I'm super honored to have with us 4 insightful panelists. 2 of them are representing CFI's research and 2 of them are representing their unique perspectives from their markets. So I'll ask them to turn on their videos now. So from CFI, we have Denise Dias, who has been a consultant for CFI, leading research on regulatory flexibility. She is a senior policy, regulation, and supervision expert. She has got a renowned and extensive career as a former bank examiner herself at the Central Bank of Brazil, and she's worked for many, many years with the World Bank, CGAP, GIZ, the Toronto Center, and most recently with CFI. So we're really happy to have her here. Also from CFI, we have Eric Noggle, who's been leading CFI's research on the financial health and micro and small enterprises all around the world. Eric is also newly leading our work on climate and financial services. So we're really excited to have him here. Prior to joining CFI, Eric worked for Microfinance Opportunities, and he's led dozens of financial diaries studies. So great to have you here, Eric. Next, we have Mohsin Ahmed, who is the CEO of Pakistan Microfinance Network, or otherwise known as PMN. Mohsin has been I want to call him a force for change in the sector in Pakistan. He's worked closely with regulators in the country, representing the interests of PMN members, and supporting the development of a strategy with the State Bank of Pakistan, as well as many initiatives that have really helped to facilitate growth of that industry, including a credit bureau for microfinance institutions, a disaster management fund, among many other initiatives. So welcome, Mohsin. And then finally, we have Rashmi Pillai, who is the Executive Director of the Financial Sector Deepening in Uganda. So Rashmi also has quite extensive experience in both in East Africa and South Asia. Before joining FSD Uganda, Rashmi worked with CGAP and the Better Than Cash Alliance. She's led global learning programs on merchant payments, innovation and scalable solutions to meet credit needs of micro and small enterprises, which is particularly relevant for this webinar. She's also been an entrepreneur herself and has set up a data platform that documents pipeline for deal flow pipeline for for-profit social enterprises. So welcome all panelists. Thank you so much for joining us. So to kick us off, I just wanted to get a sense of where we are today. You know, what's the context that we're operating in right now? And I thought we would start with what the data from the micro and small enterprise surveys are showing us. We've been doing this, you know, collection of waves of data. So Eric, I'm going to hand it over to you. If you could tell us a little bit more about what you're seeing from the data across the markets. You're on mute, Eric. So you.
There we go, unmuted. Absolutely, thanks Mayada, and thanks everyone for joining us. So we've been collecting data in 4 countries starting in about June. And the surveys that we're doing once every 2 months with a staggered rollout. We started in Nigeria in June, and we did our first wave survey in India in October. And our goal in each of those surveys is to survey 400 micro and small enterprises in each wave. And to date, we've done about 5,700 interviews. So we're collecting a great deal of data. And the clients that we're interviewing are all clients at financial institutions that we're partnering with under our partnership with MasterCard, these institutions are going through this digital transformation. And so many of them are sole proprietors or micro businesses. And I think it's also important to mention, while there are differences by country, our sample is roughly balanced by gender as well. So we have good representation of both male and female-led micro businesses in our sample. And as we've alluded to in the opening remarks, one of the big things that we saw in that first wave of data was a really dramatic retraction in the business activity of these micro businesses globally. So just to give you some highlight numbers, across the 4 markets, we saw 15% of businesses close down at the start of the pandemic. 83% of MSMEs saw their profits decline. Employment declined by 53% amongst the micro, small, and medium enterprises. And then we saw major impacts at the household level as well, because we know that especially for those sole proprietorships and the micro businesses, that there's a very tight link between the performance of the business and the well-being of the household. And we saw dramatic declines in food security. So a lot more people reporting that they were having to go to bed hungry because they couldn't afford food. And then massive drop-offs in financial activity. So savings deposits plummeted, but withdrawals stayed at the same rate. Borrowing largely stopped. There's a reduction in cash transfer activity. So what we saw was just this massive retraction in liquidity that was available to these businesses. When we analyzed the wave 2 data, we were heartened to see that there was a bit of a rebound. So we saw a lot more businesses that were closed that had reopened. There had been a stabilization in the decline of profits. So a lot more people were saying that their profits were stable or increasing again. And employment had increased dramatically. And in India, for instance, it actually exceeded the level that we saw before the pandemic. And so we thought those were all really positive signs. But there were still many indicators of concern. So for one, the businesses that were reopening, most of those owners weren't restarting the business that had closed. They were starting a completely new business, and the demands on that are obviously much different than if you're just opening up a previous operating shop. Savings had been largely exhausted in every market. People were, reported that they had spent down 50% of their savings or more. So that cash cushion has really been eroded. And then we saw that the recovery really hasn't trickled to the household level yet. So food insecurity is remaining persistently high. People are still having trouble covering their household expenses. And so when we analyzed the Wave 2 data, we just published a blog on this. We said there was reason for cautious optimism because the recovery was happening, but it was very fragile. And since then, we started analyzing the Wave 3 data, and we just completed the analysis in Nigeria, and we're seeing the recovery there plateau a little bit. So we're still seeing some incremental progress, but that the pace of that recovery has really flattened out. So I think that gives that cautious part of the optimism a little bit more weight. And in terms of our conversation about policy, and then Maya, I'll turn it back over to you. I think one of the things that's important to note is that we're not seeing a lot of policy measures reach the MSMEs that are in our sample. So even though there's been pretty dramatic expansion of direct assistance programs in each of the markets that we're working with, we're not really seeing a huge uptake at the MSME level, either in terms of the business or the individual owner. And that's corroborated by data we're seeing in other places as well. The World Bank just released a major survey of small enterprises that they did and found that only 10% of them are getting direct support of any kind. So based on what we're seeing, there's a big need here, and I think it'll be a good point of discussion for us in the rest of the webinar.
Great, thank you, Eric. So this kind of gives a lay of the land of what we're seeing on the micro and small enterprise side. Denise, I know you've been talking to policymakers, regulators, providers from a larger market sample than just the 4 countries that Eric just talked about. Can you tell us what you've been seeing in terms of what's been tried, what's possibly working, and what's maybe not working?
Yeah, thank you, Mayada. So we just need to start with the broader context, right? This is like an unprecedented regulatory response to a global crisis. I don't remember even studying something like this where regulators for so many different countries taking very similar kind of measures. The main concern really for the financial regulators globally was to immediately counterbalance the negative impacts of the lockdowns and the limitations on movements of businesses and people. So when they realized that the borrowers across all economic sectors were going to face sudden prospect of not being able to repay their loans, the regulators needed to pass a message to the regulated sectors. And the message was really to say, we understand what's going on, we will give you support, we will do the best we can, so please continue supporting the economy. It's not only technical issues, but it's really a reaction to show the financial sector that the regulators were going to support them. One of the main ways they showed this type of support, they tried to help the industry, and everybody's kind of aware of that kind of measure, was to allow institutions, the lenders, to give relief to their borrowers, such as through moratoria or other kinds of restructuring, without the burdens, the normal burdens of prudential regulation. So our paper looked more on the prudential side of the measures, although we will talk about non-prudential and fiscal measures because they're very important. But the main types of prudential reactions, prudential flexibilities that the regulators used in this crisis was to allow the reclassification of these loans that were receiving moratoria or other types of restructuring, because that's normally what's it's done, the automatic reclassification, which leads to more provisioning, which leads to more capital requirements. So instead of doing that, they allow the industry to keep the liquidity to be able to weather the crisis and support the economic sectors, including MSMEs. But there were a range of other types of measures. Prudential measures is still, so we describe them in more detail. We won't have time to talk about all of them here, but for example, reducing capital requirements, reducing capital adequacy ratio requirements, reducing reserve and liquidity requirements, other measures such as reducing some collateral requirements for certain types of loans. So there was really a very large range of prudential measures and a few non-prudential measures, but still regulatory measures that were taken, for example, protecting borrowers that were receiving relief from their lenders, especially in terms of credit information. So they were trying to protect the credit history of these borrowers, and also limiting discretionary payments that financial institutions usually make, such as dividend payments, because you're releasing liquidity in one side to support the economic sectors, but then you need to actually limit how the providers use that extra liquidity. And just to finalize the types of measures, so the prudential, non-prudential, regulatory, but there are also non-regulatory measures such as central bank liquidity facilities, tons of central bank liquidity facilities across the countries. This was really varied across the countries. Credit guarantee schemes that were either set up or changed, tweaked a little bit to deal with this crisis. And most importantly, and this is a fiscal measure, cash transfers and other types of direct supports to MSMEs and also to individuals. And although Eric actually noted that at least in his sample, not a lot of the MSMEs were receiving this direct support, but they were very important and they complemented the regulatory measures. So these were the main types of measures.
Great. So we'll talk more about what's been reaching the segments we care about in the next round. But for now, let's switch to Uganda. Rashmi, we've heard that the situation in Uganda has been somewhat mixed, and I know that you're sitting, at FSD Uganda. You have this, bird's eye view of the entire sector, and you're working with the regulators as well as with the providers. Can you tell us what you're seeing? What's happened in Uganda? What do you think has been effective, and what is possibly not been as effective in the market there?
Great, thanks, Mayada. So Eric and Denise have mentioned. Just to give everybody on the webinar a little bit context, the minute Uganda had the first COVID case, it went into an extreme lockdown all the way from towards the middle of March to August in case of certain segments. So it created a big shock to the economic sector. It also created more acute shocks in certain segments. For example, a big portion of foreign direct investments, etc., and hard currency comes to tourism, that very quickly disappeared. The second was the transport industry and inter-country logistics industry, because we are a landlocked country, got severely impacted. That had impact because also in terms of commodities, because Uganda is what is considered the food basket of the East African region, and we export food crops to neighboring countries. So there were very interesting effects. One of the, I'll come to the financial sector side and then how MSMEs, because they relate to each other. But when you talk about people and businesses, couple of things. One is when countries went into lockdown and all logistics and supply chain came to a standstill, Ugandan exports in terms of food crops were simply lying at borders. If we had excess supply of food in the country, it crashed all commodity prices. So we had excess of milk, we had excess of food grains, and because we have 2 seasons of food crops that we grow, or certain kinds of crops, and Kenya has declared a dead year for the schools. So institutional buyers that buy food crops, like the Kenyan schools, Ugandan schools, all the hotels, these institutional buyers did not buy that. So immediately, what people thought that you would see impact of this on tourism, you'd see it on other big industries, but did not realize that agriculture would have such an immediate impact as well. So we're taken aback, and that had an immediate impact on agro processors and smallholders for some amount of time during the lockdown. Now, if you talk about also micro businesses, you can divide them into certain segments. So transport, to give an example of how did that impact transport, I don't know how many callers know, but most of East Africa, public transport is a combination of what we call matatus or small vans, or it is motorcycle taxis. One of the largest asset financing company that does motorcycle taxi financing, and the taxi drivers pay weekly because it's a higher purchase asset finance. The company's repayment rate went from 93, 94% a week to 3%. So that's the kind of impact that certain industries were noticing. And these are owner operators, you know, even you're talking about small transport, you're talking about micro businesses, owner operator businesses. So all of this now coming, you know, now zooming out and coming into the financial sector, the first thing that a couple of measures, exactly as Denise mentioned. The central bank reduced the central bank rate. CBR went from 9% to 7% very quickly. Did not have a big impact on the overall commercial bank interest rates at all. Big revelation to a lot of folks on, you know, how that's working out. The central bank in Uganda did allow for a moratoria for an entire year, so you could restructure your loan up to 3 times, and at some point they even waived that. But what they also allowed is not reporting on those loans to the CRB, to the credit information systems, and that created a little bit of an information asymmetry. April 2021, we're nearly there. At this point, the banks have restructured 8 trillion shillings worth of Ugandan loans. That's about $2 billion. And to give context, the size of the Ugandan GDP today should be about $35 billion. So 2 billion of which, you know, like it has been restructured in terms of just banking sector loans. Now, in terms of relief, as of today, the Uganda Development Bank, which is, you know, gives concessional financing, the government has approved a bailout to the tune of 444 billion shillings. I'm sorry, I have to do the conversion, but I think that's about $120 million. So in a nutshell, we are going to see the after effects of the pandemic for some time. And it is going to stay here, especially for small businesses. There will be some businesses in the healthcare sectors or some businesses that were largely more resilient based on the kind of industry or service they were providing. But there are others like entertainment, theaters, tourism, even cross-border women traders. And our own macro analysis showed that it would take about 1.8 very micro businesses, largely owner-operated businesses, up to 2023 to get to pre-pandemic levels. And majority of them are women-owned. So that should give you a sense of where we are today. What you will notice in Denise's paper and Denise and Loretta's paper is that the deposit-taking institutions and world over have fared better off than non-deposit taking institutions. But in countries like Uganda, non-deposit institutions are the ones that serve majority of the clients. And because they experienced such severity so quickly, either because they were not digitized enough, multiple of them had those issues. They had to very quickly figure out unique ways, but for a long time we're facing challenges, including furloughing staff, and had to, in some cases, completely shut down branches. There are also other kinds of non-deposit taking institutions, like the new age digital credit providers. Most of them are lending off their books in multiple African countries. They're still young, they're still lending off their books. They had to renegotiate all of their loans from their primary lenders. And that was quite an exercise. So I'll stop there. Hopefully it was not too overwhelming.
No, it's very rich. There's a lot of really interesting stuff we need to dig deeper on. So we'll come back to you. So I want to turn to Mohsin on Pakistan, because Pakistan is a unique country in that it has pretty sophisticated infrastructure and a very responsible central bank, PMN, a very successful entity that has been supporting the inclusive finance industry for a long time. And I just wanted to get a sense from you what you're seeing. Pakistan has had many, many crises. It has stepped up many times in the past. How has it dealt with the situation under COVID? And what are you seeing that's working or not working?
Okay, thank you, Mayada, and grateful for being one of the panelists. So what happened in Pakistan is slightly different from Uganda. And now, in terms of the current situation, we are going into a third surge. So I will talk in detail about this. So what happened? So the pandemic hit us around March. Middle of March 2020. 23rd March was the date when Pakistan went into lockdown. And the good thing is that immediately, as soon as we went into lockdown, we immediately contacted the two regulators. So for the banking sector, the central bank, and for the non-banking sector, the Securities and Exchange Commission of Pakistan. Also, the fact that Central Bank of Pakistan is also a key player in financial inclusion, and they have been promoting the non-bank sector. So engaging with them at a higher level also for the non-bank sector, especially on the liquidity side. The first crisis that we had to manage was that because of the lockdown, institutions outside, so the non-banks were closed. Banking sector, because they were also providing deposit services, so they were allowed to operate with the following of SOPs and WHO guidelines, but the non-bank sector had to suddenly close down. So the business operations, whatever different guidelines, they became totally ineffective. But when we contacted the Securities and Exchange Commission and the central bank, they were immediately helpful in terms of engaging with the central and the state government and the provincial governments to allow the non-banking sector to operate also. And two of the state governments allowed, one didn't allow, but they were allowing the NGOs. And given that the non-banks also had as their partners NGOs also, so they engaged through them in having interaction with their clients. So the point was that they wanted to operate because they wanted to talk to their clients and discuss with them the kind of problems that they are facing, how these entities can provide them help, and also how they can send messages in terms of recovery. The second immediate thing, which I would say happened with outside of our advocacy function also, because as mentioned by both Denise and my other colleagues, that the central bank and SECP immediately also reacted in terms of providing the deferment of loans. So circulars on the loan deferment were issued, I think, within a couple of weeks, or I think even within a week of the lockdown, so that at each tier of borrowers, you could engage with your lender and get your loans deferred for between 3 6 months and 1 year. For the banking sector, central bank gave a 1 year loan rescheduling, but for the non-bank it was more flexible in nature. So the non-bank gave it between 1 month, 3 months, and 6 months, whereas the banking sector gave it for a year. And so the trends that we have to see for how is the rescheduled loans borrowers now going to repay will now start happening in the next couple of weeks. But what we can see from the non-bank sector, which gave deferment of loans for 1 month or 3 months or 6 months, what we have found out is that the more shorter the period of loan deferment, the better the recovery is. So let's see what happens as the 1 year maturity happens. Secondly, the second big benefit that came and that came from the central bank, both for the bank and the non-bank sector, and that was around the policy rate of the central bank. So the policy rate was almost halved. So Pakistan was going through an IMF program prior to the pandemic, and interest rates were on the higher side. The discount rate was around 13.5% prior to March 23rd. It is right now at 7%. So it was almost reduced so that there is stimulus and liquidity in the market. So central bank immediately pushed for that. Similarly, central bank came up with a very interesting scheme, which is providing liquidity through giving guarantees, central bank guarantees for both SMEs and it includes micro, small, and medium enterprises, but also includes the non-bank microfinance organization. And this was around what we call a salary and wage scheme. This was for a 6 months period. So if a particular non-bank entity or a MSME committed that they are not going to lay off any staff, they were given a very discounted loan at 2-3% for 6 months to cover the salary cost of their clients. This was a huge liquidity help for the microfinance industry. In terms of the way the clients behaved, So the lockdown in the country, in Pakistan, was turned out to be a shorter period of time. So it was not 6 months or 9 months. It was actually 2 months. And between March 23rd and May, end of May, when Eid, just after the Eid al-Fitr in Pakistan, which is the Eid after the fasting of the month of fasting. So Pakistan started opening up, and the opening was at all levels except for hotels and tourism and education. So all other markets and all other businesses started opening up. And so the process of opening up became widespread till we reached fall. And fall was where we had the end of October, when we had the second surge. But the second surge was much shorter. So within a period of 45 days, I don't know what is the reason behind it, but within a period of 45 days, so by mid-December, we have been able to manage the second surge also. And so businesses continue to open and were operating. However, there was this element of uncertainty, and so nobody was expanding. Everybody was looking at managing their cash flows and continuing with whatever their current operations are. And so at the macro level, we are expecting that our growth rate will this year, between July June 2021, will be around 1 or 1.5%. That's what World Bank and IMF forecast. And so the business can have continued to operate, and we were expecting that we are entering spring. So this is spring season in the country, and so we thought that the worst is over, and we are off with the winter. So and vaccines have started come. So people have started getting vaccinated. So all our elderly above the age of 65 are now being invited to be registered, and they will be vaccinated. So we were expecting that we can now move into a growth curve. But suddenly last week we have entered into a third surge, and so the news is that because traveling has opened up, so people who were coming back from Latin America or from UK, so some strains of both UK strain and Brazilian strain has hit, and so it's a very widespread surge. So suddenly what we are seeing is that the infection rate has reached 11%, which has never happened in the last 1 year in the country. And so again things are moving back. Marriages, which this is the time when we have marriages before summer, because I am sure you all know that in South Asia, summers goes up to 45 degrees centigrade on average, 40, and it goes up to 45 also. So people make sure that all the marriages happen by the end of March or early April. And so a lot of business was expected during this time, but now all of these are being closed down. So I don't know how will this pan out, but this was very unexpected for all of us. We are now moving into a recovery phase, and things will settle down. But I think we will have to wait for another couple of months before the real summers arrive, and last summers were much easier in Pakistan. So that's a situation currently on this front.
Thank you, Mohsin. So several things have come up here. So obviously, very different realities in different markets. Different sectors are affected. Bank, non-bank, lenders, and how things kind of trickle down to these kinds of different entities. And I want to turn to Denise again. I know you're answering one of the questions that has come up, which I was going to weave into this as well. But it's so this bank, non-bank issue is a big one, and I think you touch on it in the paper, but it definitely comes through. The liquidity issue feels very different if you're a deposit taking versus a non-deposit taking institution, and how these prudential measures that affect you also are obviously very different as an institution. Can you talk a little bit more about that, what you're seeing, and then what you would advise regulators and other policymakers to do in light of this difference between bank and non-banks?
So I think it's true. So from my conversations, the deposit-taking institutions, even if they were serving MSMEs and low-income segments, they fared better than the lending only. And that is because it's just because of the simple fact that they had extra liquidity to tap into during the crisis. But the big difference on the prudential measures, if you compare a bank with a non-bank, It's because the banks are usually much more regulated prudentially. So there was a lot more room to open, in terms of prudential requirements. So a lot of the measures that were with the objective of releasing liquidity and capital, they were for banks. They didn't work for non-banks because the non-banks didn't have those requirements in the first place. So for example, capital buffers, or the more strict capital requirements, or even the liquidity support that the central banks gave, they mostly benefited banks. So for example, all the institutions I talked to, they could not benefit from central bank liquidity facilities because these facilities either required conditions that the non-banks could not meet, or the non-banks were not under the purview of the central bank, so they did not qualify at all. The credit guarantee schemes the same, although we do know of very good credit guarantee schemes that worked well during the crisis, including India, Peru, and Colombia. But in general, what happened in terms of releasing liquidity and supporting the non-banks was that there was a lack of customization. So I think the advice is really to look at customization, customizing the measures to the non-banks. But for that to happen, both on the technical side and on the timing side, because as Rashmi said, these non-banks, they actually see a quicker deterioration of their portfolios. So the measures actually needed to be faster than for the banking sector, but of course, the regulators were all concerned with the banking sector. So for customization to happen and to happen quickly for the next crisis, the regulators need to step up their knowledge about the sector. They need to step up the knowledge in terms of how this business work, but also get data. They didn't have the data on the portfolios. They didn't understand how the portfolios were operating prior to the crisis. So during the crisis, they imposed more reporting requirements exactly in the moments where the non-banks could not deal with more compliance costs. So it's this, if I am to give any major advice, is prepare for the next crisis, to customize the measures and to be quicker instead of doing what you did in this crisis, which is simply extending the measures that were designed for banks to the non-banks. But some of them didn't work, but some of them worked. But that, I think that's the main advice.
Thank you so much. Mohsin, I want to just go back to you really quickly because you gave an example of liquidity coming into the non-banks by supporting the salaries. And then we also know that Pakistan did a pretty extensive cash transfer program. And I wanted to, are you seeing the effects of these in terms of the liquidity of the non-banks? Are you seeing the effects of these in terms of the portfolio quality of the non-banks? Can you speak to that? You have to unmute. Yeah.
Okay. Yeah. Thank you. So in terms of liquidity, and especially the cash transfer program. So Pakistan has a very extensive cash transfer program, and it goes back 12, 15 years. So started almost in 2009 or 2010. And it has extensive outreach now using digital channels also. So as soon as we, as I mentioned, we went into the lockdown, so on the one side, central bank, by reducing the discount rates, provided fiscal stimulus and liquidity to the market at a lower price, but also the federal government came up with extensive cash transfer programs. And I think in the first month, they announced a cash transfer of 12,000 rupees, which is around close to $75 per person and this was immediately transferred to the lower income segment. So I think it was transferred to around 10 to 12 million families in a period of 2 to 3 months. So it provided the necessary cash support at the base of the pyramid. Similarly, the availability of liquidity in terms of salary and wages at a lower rate provided the necessary liquidity to the non-bank industry. Now, if I move into all of this, despite the liquidity, which was on the one side as a cash transfer program available for families, the other liquidity that was made available for non-banks. But the bigger is the major challenge that we are facing right now is liquidity. And all the regulatory support up till now has been in terms of relief. But as we move into business, and as businesses started re-emerging, they all will require, whether they were rescheduled loans or non-rescheduled loans, everyone is now requiring liquidity. And that is one thing which is still missing given the uncertainty. So we as a network are advocating with both the central bank and the government and the multilateral that a support of around close to $500 million is required for restarting livelihood and SME businesses, micro and small businesses especially. So that is still a challenge, especially for the non-banks, but MFBs are also looking for this kind of support. And also in terms of guarantee schemes are also something that is being required for especially rescheduled or deferred loans.
Right. Rashmi, I wonder if you could come back with your video and then maybe touch a little bit about, because when in our prep call, you had talked about some of the challenges Uganda faced with getting, choosing not to do cash transfers to people, and the ripple effects that has had. So not only is there a liquidity problem for the non-banks, but individuals that are recipients of or getting funding from these non-banks are also not receiving cash. If you could talk a little bit more about what that situation is looking like now today in Uganda.
Okay, so that's actually a very complex question, Mayada. I
Okay.
will try to give a response. A couple of things. So we're discussing two dimensions here: is the resilience of MSMEs and their ability to recover with and without an injection, right, of an unconditional cash transfer. Kenya decided to do unconditional cash transfers, but a good unconditional cash transfer program requires, as Mohsin was describing, very good targeting. That requires understanding what is the poverty level of the household, or assuming you're not doing a blanket cash transfer, which I believe some countries did do. They just decided an income threshold, but also that requires being able to target and do a digital delivery of the cash transfer. In the case of Uganda, that was very difficult. Targeting of that nature to that scope and scale has never happened before. Second, you could target using mobile money wallets, but the latest statistics show that unique adults that have mobile money wallets are about 55% unique adults, and that created a challenge. Could we have done a unconditional cash transfer? Absolutely. Was it still feasible? Yes, you could use proxy data in terms of mobile money wallet, like how much a person is transacting, etc. But would we have reached the poorest of the poor? The answer is no, not really. We would not have reached the poorest of the poor because many people actually don't even own individual phones. They share the phones. They have SIM cards. But even with a limited unconditional cash transfer, would it have injected much needed liquidity? Absolutely, it would have. And it's unfortunate that eventually the government decided not to go with it. And we have seen the benefits of unconditional cash transfer in terms of the ability to limp back as a small business versus bouncing back, even if it's starting a new business entirely, as Eric mentioned, when you look at Kenya versus Uganda.
Just to follow up, are there initiatives like in Pakistan to try to advocate for financing of the non-bank players in the market?
So when you say financing, sorry, you will have to elaborate in what sense.
So the non-credit providers obviously have to borrow or get equity injections. So they're not going to be raising deposits. So are there efforts to try to increase the liquidity for these actors?
So so Mohsin did spend a few minutes explaining the structure in Pakistan. And in Uganda, the structure is the non-deposit taking institutions fall under a separate regulator altogether. It's not the central bank, it's the Uganda Microfinance Regulatory Authority, a very new regulator, doesn't have the wherewithal that the central bank has. So because it did not fall under central bank purview, they did not benefit from what a central bank could have done from them. Some of the large non-deposit taking MFIs actually have international headquarters and presence, and were able to negotiate with their microfinance investment vehicles very well. But the others that are regional or just country-based could not. So that's on the MFI piece. Then Uganda has a massive and a large volume of SACCOs. Some SACCOs are even bigger than the banks. And they saw, they saw mixed results. Some SACCOs had, some of them very quickly, there were increased withdrawals, but then that plateaued out. But there was not enough repayment of loans. It's some businesses or micro businesses actively chose not to repay because everyone was conserving cash. And that's the strategy that they took.
Okay, great. So Eric, I want to turn to you next. So you started to say that in wave 2, you're already seeing signs of recovery. We've seen fits and starts in Pakistan in terms of recovery. Could you talk a little bit more about what you would advise, based on the research that you've done, what are you advising in terms of supporting some of the MSMEs to restart their, get back in gear? What are you recommending?
Yeah, no, it's a question that doesn't have an easy answer, because I think one of the things that we suggested when we did our wave 1 analysis and published our paper was this need to expand the direct assistance that was going to MSMEs. And I think one of the things that we've heard today is the difficulty in targeting that if you don't have really strong sort of infrastructure and plumbing in your identity and financial systems. And so I think that that'll speak to sort of my third stage long-term question. But in the short term, it's, how do you maximize the tools that are in play, like some of the things that Denise talked about in terms of prudential flexibility, because that's one of the more direct ways you're going to be able to get to these, small businesses that are active in the lending market. I think for beyond that, there are some tough policy, fiscal questions for governments, because if you have to go really broad with these payments, the price tag on that looks a lot different, right, than if you're having to target. And so if you're resource constrained, that's problematic. I think that there's going to be a lot more for governments and policy makers to do if they start looking in the medium and the long term. I think in the medium term, I think there's questions about how do you build up the capability of businesses to withstand shocks generally, both in terms of their management and business practices, and then sort of in the longer term, how do we start thinking about sort of, again, this plumbing and infrastructure question in a different way. So how do we make sure that they're plugged in and connected? Can we, can there be government sponsored things like bolstering the tax system, right? Which helps register small businesses, gets them visible to the government so that they can be responded to in a shock. So I think that is one of the things that policymakers need to start thinking about, because if we're seeing the recovery plateau in the other markets, like we saw in Nigeria, I think that's going to be an indicator that we still need to be providing that short-term assistance, but it's also going to be a sign that we need to start planning for the next shock. And we know because of climate, obviously, this pandemic, sort of put things into a stark perspective that these things can come quickly and sort of surprisingly. And so planning for that now, I think, will be really beneficial for those entities.
Great, thank you. So I know we've had a couple of questions and they've been answered, but if there are other questions, please go ahead and send them through the Q&A, and we do have about 7 minutes left. So I want to do one last round of conversation, just thinking ahead on the recovery. So Eric already started to touch on that. Mohsin already mentioned the need for liquidity and the efforts that they're making to try to convince international lenders to come in and support the sector. But I'll start with you, Mohsin, again. Are there other things that you want to to flag as priorities for the recovery phase? I know you just said that, you know, you've just hit the third lockdown in Pakistan, so maybe your mind is not yet at the recovery, but hopefully it will be a short period that you're going through now. So I'll hand it over to you to talk about, you know, what do you see as priorities for the recovery?
Okay, I think going forward, if there is one investment that needs to happen, especially for a country like Pakistan, we are known as a third world country, so there are reasons for that. It includes that governments and infrastructure are not that strong. And Pakistan is amongst those countries which is, in terms of climate effect, is recognized as amongst the top 5 countries which will have an effect because of climate change. So what we are advocating for is, like you mentioned in my introduction, also having a disaster risk fund for the microfinance sector. And we think on the one side, that fund should have a governance structure, which I don't know what is the right governance structure, but a structure which allows both this sort of an insurance platform backed by an insurance platform, but on the other side it should be able to cover not only the losses that institutions face, but the write-offs that we will have to do if another crisis happens. So there should be a grant component, and then there should be an emergency liquidity component. So rather than going after different stakeholders, there should be an institution that is there, and one should know that in case of a certain crisis or a trigger that happens, we will have access to liquidity in the form of, there could be emergency bonds, or there could be national catastrophe funds that are available for stakeholders. So whenever we move from any crisis into the time when we move into recovery is the time when we are restarting livelihoods and businesses, and that is where liquidity becomes very important.
Great, thank you so much. Rashmi, what would you identify as the critical priority for the recovery phase for Uganda?
Thanks, Mayada. I would say a couple of things similar to Mohsin, but slightly differ. If you talk to most governments before COVID and you talked about their ambitions and their national development plans, most emerging economies would tell you that we're looking at the digital economy. Very quickly realized, and I believe Payal talked about it, is you cannot have a digital economy without digitized and resilient financial sector. There's going to be no exchange of goods and services, and that's just going to tank everything. And in order to build the resilience of the financial sector, we need to have, including non-deposit, we need to relook and say deposit, non-depositing sectors. In the case of Uganda and multiple East African countries, most of them were not digitized. Most of them were not connected to ID systems that allowed for targeting, that could have allowed for resilience building. So all of that now needs to happen on a very accelerated, amped up pace. That's step one. Then the second step is actually help build the cushion for people and businesses and what systems exist. An example that Denise and Loretta give in their paper was of the Egyptian Credit Guarantee Fund and how they were supporting MFIs so that commercial banks, deposit-taking banks could then on-lend to them. And that has very significant impact. For example, when you're able to have a structure like that, non-deposit-taking institutions don't have to rely on hard currency. And hard currency intake would have significant volatility when it comes to a pandemic of this nature. So having that kind of a resilient mechanism, as Denise and Mohsin mentioned, very critical. We did not have it. Most African countries do not have it. And the last piece that is unique to Uganda was the entire refugee population. We host one of the largest refugee populations in the world. Just I think third or fourth, and It was such a challenge because the refugee camps are dense. There is no social distancing that's possible. Refugees cannot get even precautionary insurance. Nobody had thought about health insurance for refugees. So when we are talking about resilience, it's not just savings and credit. We're also talking about insurance for people and businesses as well. And that was just non-existent, and it cannot be applied retroactively, you know, after an event has occurred, after the risk. Yeah, so that's something that also needs to be factored into.
All right, so a lot to do. Just really quickly, because we've run out of time, but Denise, any kind of final words that you think are priority for policymakers, but also just the inclusive finance industry generally?
Yeah, agreeing with everything that has been said so far. So just to emphasize if we are to prepare for the next crisis in terms of regulators preparing for the next crisis, they really need to step up their knowledge about the inclusive sector. And that can only be done with data. They need to improve their data prior to the crisis. So it's very important to work on that, to improve the data. And one problem that we have in this regard is the disparity between the regulatory framework for banks and for the inclusive sector. Sometimes they are under different regulators. So that creates actually a very different situation of knowledge about the regulated sector. And the other one, just to repeat, deposit-taking institutions have a very important role. They are more resistant to crisis. So once more, one more crisis show us the importance of creating regulatory room for deposit-taking non-banks. So I would insist on that once more. It's very important. Thanks, Mayada.
Thank you so much, Denise. Eric, now from the lens, you know, from where you come from, which is, you know, looking directly with the micro and small enterprises, anything else that rises that you feel that hasn't already been said that you want to mention?
I think Denise stole my big point about just the need for additional data. I mean, I'll make a public health analogy that if you want to be able to cure the disease, you need to be able to measure progress and then adapt your intervention accordingly. And you're not going to be able to do that if you can't track information on these businesses.
Great. I know this has been super rapid, so thank you all. Thanks to these amazing panelists. We went through a lot of information in a very short period of time, so really appreciate it. I recommend that everyone looks at the papers that are coming out, and I'm just going to mention a few words that I think stand out in terms of what we talked about. I think we started with this customized solutions to serve the kind of inclusive finance industry. Data came up quite a lot, so the need to have data both on the micro and small enterprises as well as data on the providers. We talked about the need to digitize the system, the financial system, so that it's plugged in to support the different stakeholders. We talked about financial facilities that are needed to support emergency liquidity at the country level, possibly even regional or global. So those are some of the big themes that I heard. I appreciate all of your contributions. Thank you all for attending. It's been great to have you, and until next time, thank you.
Thank you.
Thank you.